private equity company that you see in that office building right over there has created almost as many dollar billionaires as the whole country of Finland.
Private equity firms are everywhere. Almost everything we consume has been touched by private equity at some point in the value chain. Despite that, very few people even know what private equity is.
So in this building right over here, there used to be a for-profit school called John Bauer. John Bauer belonged to a corporate school group that in 2008 was acquired by Danish private equity firm Axel in a so-called leveraged buyout.
And 5 years later, the school filed for bankruptcy, leaving 1,000 teachers without a job and 11,000 students without a school. Private equity has been described as capitalism on steroids and has attracted a lot of criticism over the years. After the John Bauer bankruptcy, even the somewhat neoliberal Swedish finance minister Anders Borg criticized private equity.
But despite criticism and scandals, private equity is today more powerful than ever and continues to shape our society. So let's talk about private equity. If you use the term private equity, you could technically be talking about many different things. But what I will talk about in this video and what most people refer to when they say private equity is so-called leveraged buyouts or LBOs that are made by private equity funds. Let me explain what that means.
The private equity firm knocks on the door of wealthy investors with a lot of money, for example, sovereign wealth funds, pension funds, universities, etc. And then they convince these investors that the private equity firm can give better returns on their money than other investments, such as public stocks. And to create better returns, the private equity firm takes the investors' money, then borrows even more money from a bank, and then uses all of this money to buy out a target company that the private equity firm believes hasn't achieved its full potential. And once the private equity firm has acquired the company, the magic starts. The private equity firm puts some of its magic PE sauce on the company, and et voila, after 5 years or so, it will be able to sell the target company to a much higher price, making the investors, but most of all themselves, very rich.
So what is inside this magic PE sauce? How does the private equity firm extract value from the companies that they buy out? Well, each separate private equity firm has its own secret recipe, but normally they can be boiled down to 3 main ingredients.
Ingredient number 1, life-changing rewards. To add sweetness to the sauce, the private equity firm promises the company's management and themselves life-changing bonuses if they meet certain thresholds. This ensures that the bosses will work extremely hard to extract value from the target company. Ingredient number 2, back-breaking debt. To add some bitterness to the sauce, the private equity firm makes the target company responsible for all of the back-breaking bank debt. Ingredient number 3, full control. To provide texture to the sauce, the private equity firm takes control of the target company to impose super smart management techniques.
Let's try to understand these 3 ingredients of the magic PE sauce a little bit better. And let's try to think about the consequences of these ingredients. So right now I'm walking in what some people would call the true epicenter of Swedish finance. Behind that building we have the Swedish Central Bank. A bit further down there we have the headquarters of Spotify, and close to that we have the law firm where I used to work. But more importantly, in that office building right over there we have the headquarters of private equity giants EQT.
EQT is by some measures the world's 4th largest private equity firm. It's so immensely successful that it has, since its IPO, created 4 dollar billionaires. And just as a reference, the whole country of Finland has 7 dollar billionaires. And just this company has 4 of them. And to get a sense of how much money a dollar billionaire has, if you earn an average Swedish salary, you'd have to work 23,000 years to earn $1 billion. How come the handful of people who are partners at private equity firm get so immensely wealthy? The answer to that is simple. As the recipe prescribes, the magic PE sauce must include life-changing incentives, which means that the fees that private equity firms charge must be out of this world. First, the private equity firm charges an annual management fee, usually 2%, of the money that the investors put into the fund. This is a fee that they get irrespective of how the fund performs. Second, the private equity firms also charge a performance-based fee, which is for some reason called a carried interest. This performance-based fee is usually 20% of the profits that the funds make. And in addition to the management fees and the carried interest, many private equity firms also charge the target companies that they buy various fees with creative names such as deal fees, service fees, and advisory fees.
As if all of those fees to the private equity firm wasn't enough, there's a lot more that the investors have to pay for.
Leveraged buyouts are really complex transactions, and private equity firms don't know how to do them. So they take in hordes of extremely expensive consultants to do the transactions for them. Lawyers, management consultants, bankers, accountants, etc. All billing handsomely by the hour.
If you average out all of these fees that the investors have to cover, you'll find that investors have to pay between 6 and 7% to invest in private equity.
To compare, hedge fund investments cost around 4%, active mutual funds around 2%, and passive mutual funds less than 1%. If you have capital to deploy, private equity is an extremely expensive way to do it.
So why do investors, such as our pension funds, still invest in private equity? Why do they accept that so much of their money goes into the pockets of a few private equity partners and all of their consultants, when there are cheaper investment options? Surely that must be because private equity clearly outperforms everything else that is out there.
And for sure, the private equity firms and their lobby organizations, such as the AIC and the SVCA, will tell you that yes, private equity does outperform other investments, and that the life-changing fees private equity firms are charging are not only worth it, they are a key reason for why private equity firms perform so well. Also, the consultants who bill by the hour to enable the buyouts, the lawyers, the bankers, the accountants, the management consultants, will gladly attest to how much value private equity firms can create.
But many independent experts are quite certain that private equity does not clearly outperform other asset classes.
The University of Oxford professor of finance Ludovic Phalippou and several others makes the case that private equity funds do not clearly outperform other asset classes. Instead, private equity has given investors performance that more or less matches the public stock market indexes. And if that is true, then anyone who invests in private equity will pay around 7% per year when they could have paid way below 1% per year for a similar return.
But even if private equity would clearly outperform other asset classes, I still find it difficult to accept that these fee levels are necessary. Should we really believe that private equity partners wouldn't go to work unless the investors, in other words, our pension funds, give them billions of dollars in fees?
Clearly, there is something foul about the incentive ingredient in the magic PE sauce. But unfortunately, also the other two ingredients smell a bit funky. When private equity firm Accel bought the John Bauer School Group, they loaded it up with a mountain of debt. Immediately after the acquisition, John Bauer had to start paying huge sums in interest to service this debt. And as long as John Bauer kept expanding as much as Accel had expected and projected, everything was fine. But when John Bauer no longer was able to attract as many students and failed to increase revenues, things got tough. John Bauer had to start cutting costs to afford its interest payments, and scandals soon started piling up. And in 2013, John Bauer had to file for bankruptcy.
Remember that backbreaking debt is a key ingredient in the magic PE sauce.
The private equity firm borrows around 80% of what it costs to buy a company and makes the company responsible for that debt. And why do they do that? Well, this debt or leverage increases the private equity firm's potential return on investment, In other words, how much profits they can make, but the debt also serves other purposes. First, it lowers the target company's tax liability. Second, it supposedly makes the target company more disciplined. The company must keep its costs low and revenues high in order to afford the debt, otherwise it fails. But this debt that the private equity firms load onto its target companies also makes the target companies much more vulnerable, increasing the risk of failure, which is what happened to the John Bauer School Group.
The beautiful thing for private equity firms is that when that happens, when their target companies that they've bought out succumbs to their debt obligations, it's not the private equity firm's responsibility to repay any of that debt.
When their investments do well, the private equity firm reaps astronomical gains, but when their target companies fail, the true losses fall mainly on other stakeholders. The company's employees, its customers, its suppliers, its creditors, and the community at large. A fate that John Bauer's teachers and students had to experience firsthand. The third ingredient in the magic PE sauce is that the brilliant private equity partners take full control of the target company so it can unlock value thanks to the private equity firm's superior management skills.
But it should go without saying that a private equity partner with little or no experience from a particular industry cannot improve the actual products or the actual services of a target company. All this private equity partner, this glorified financial intermediary, can do for its target company is to deploy the bluntest instruments that capitalism has to offer.
The private equity firm helps the target company cut costs through layoffs, offshoring and asset stripping, and the private equity firm helps the target company increase revenues by deploying state-of-the-art methods for price increases. In other words, what private equity firms do is to help target companies focus more on financial engineering and consumer exploitation and less on improving the company's products and services. Or as the author Matt Stoller has expressed it, private equity firms act as disease vectors for price gouging and legal arbitrage.
But to extract value from the target companies, some private equity firms are not satisfied with only firing people and raising prices. Some private equity firms have bigger plans for their target companies. Market domination.
This right here is Ryds Bilglas, a Swedish car glass repair chain. This chain was founded in the 50s and was in 2016 acquired by the private equity firm Nordic Capital in a leveraged buyout. Immediately after the acquisition, Ryds Bilglas initiated its strategy of market domination. When a private equity firm acquires a company on a fragmented market, in other words, a market where there is a lot of competition, then the private equity firm will inevitably try to destroy as much of that competition as it can so that it can start raising prices. After Nordic Capital took over Ryds Bilglas, it initiated a wild shopping spree, acquiring on average one new company per month.
In theory, our competition and antitrust laws should prevent the private equity companies from going too far in their attempts to destroy competition. But in practice, the private equity companies can often get around the competition authorities with the help of stealth consolidation, as the University of Chicago professor Thomas Woolman has called it.
Stealth consolidation is possible when each separate acquisition is small enough to fly under the competition authorities' radar. Either the authorities are clueless as to what's going on, or they lack the weapons to defend. And this is particularly common in the retail sector. The private equity firms have also, with some help from their lawyers, built a whole nomenclature to obfuscate the true purpose of their consolidation strategies. Private equity firms doesn't monopolize. It acquires a platform and then makes add-ons and bolt-ons and tuck-ins. Private equity doesn't destroy competition, it makes the market more efficient. And private equity doesn't do price increases, it does margin expansions.
If and when the competition authorities finally wake up to what private equity has been doing below its radar, it's often already too late.
After a few years of extremely aggressive consolidation, Nordic Capital last year sold off its control stake in Ryd Spirglas through an IPO. And in the IPO prospectus, Ryd Spirglas even brags about its successful stealth consolidation and how it has created market entry barriers that will make it difficult for small competitors to stay relevant on the market. The car glass industry is just one example, but the same dynamic of aggressive private equity consolidation is playing out across a multitude of industries right under the nose of our competition regulators. While many competition authorities, including the Swedish Competition Authority, shows little or no interest in seriously scrutinizing aggressive private equity consolidation, a seismic shift is actually taking place right now in the United States of all places. Jonathan Cantor, head of the competition department at the US Department of Justice, has said in an interview that the private equity firm's business model of rolling up industries often is very much at odds with the law and very much at odds with the competition we're trying to protect. Also, Lina Khan, who leads the US Federal Trade Commission, has signaled a readiness to take on anti-competitive practices by private equity firms.
During the last 30 years or so, we've let glorified financial intermediaries spread its magic PE sauce all over our society. And it's getting clearer and clearer, at least to me, that the ingredients of this sauce are pretty foul.
So, full disclosure, during my career as a lawyer, I've worked for law firms that obviously represent the private equity industry that I lament in this video. And some of my best friends still work for the private equity industry directly or indirectly. And the funny thing is that the people I know who work for private equity are the most brilliant and hardworking people that I know. And I believe that this is actually a problem. It is a problem that the most brilliant and hardworking people in our society wants to work for financial intermediaries that shuffle companies and money around instead of creating anything new. But given the money in private equity, who can blame anyone for wanting to work for that industry? Thank you very much for watching this video about private equity. And to be honest, criticizing private equity is probably not the best business decision that I've ever made. But my goal with this channel, The Market Exit, is not to get corporate sponsors or private equity sponsors, but to stay independent and to be able to do videos that speak truth to power. And if you want to help me stay independent and keep making videos like this, you can become a Patreon at patreon.com/themarketexit. And to the patrons I already have, thank you so much for believing in this channel, even though I just got started. Your support means a lot to me. Thank you. And if you want to know more about private equity, I would recommend Ludovic Phalippou's book, Private Equity Laid Bare. It's a really good book that is actually fun to read. And I would also recommend the podcast Capitalism, hosted by Luigi Singales and Bethany McLean. It's probably one of the best podcasts on economics out there, and they have some pretty solid episodes about private equity that you can check out. That was it for this video. I hope I see you in the next one. Goodbye.